The RBA has shocked markets, with the central bank delivering the biggest rate hike in 20 years. This was the first back-to-back rate hike in 12 years, and investors, analysts, economists, and homeowners are now wondering what happens next. Today, we're going to be discussing the story and unpacking what this could mean moving forward. Of course, many were anticipating and forecasting a 15, 25, maybe a 40 basis point rise, but this was far higher than was anticipated by most. And so today, we're going to dive into the story.
Sit back and enjoy.
And so here we have it. Here's some of the supporting commentary that went with the RBA's decision as the central bank decided to raise the cash rate target by 50 basis points to 0.85%. Of course, there was a lot of divergent opinions and discussion prior to the rate rise. Would it be 15, 25, 40 basis points? Not many economists or analysts at all had 50 basis points, and so it did take the market by surprise. And we saw some of the flow-on effects as well at the ASX level, as well as with the bond market and the AUD-USD pairing. Of course, it's always interesting looking at the central bank's decisions and the commentary they have providing with it, because it gives us an insight into what the central banks are thinking, what are the key data points that they're waiting to continue to make assessments on, and where they think things could be heading moving forward. Of course, knowing that we're in a very fluid and evolving environment, and this is not isolated just to Australia. So here are some of the key factors that the RBA really drew out with their decision for the month. Inflation has increased significantly. We know we got the last quarterly results, 5.1% at that top line, 3.7% with the underlying inflation. It's well ahead of the 2 to 3% band sustainably, which of course the RBA, like many central banks around the world, wants inflation to play at. While inflation is lower than most other advanced economies, and we've seen a lot of discussion as well that, of course, for the upcoming quarter, it's likely that inflation will be hotter and running hotter than the past quarter. Unlike some of the other nations like US, where CPI is on a monthly basis, we wait quarterly for those headline numbers, but we still get a few different proxies or a few different data points that can help us get an insight into the trajectory of where things may be heading for the next quarterly batch. Of course, we know global factors, including the virus, supply chains, war in Ukraine, there's still bottlenecks, accounts for much of the increase in inflation. And so this is discussing a lot of the supply side factors, but domestic factors are playing a role too, with capacity constraints in some sectors. We know about the goods shortage, the raw input prices uplifting, as well as, of course, the tight labour market as well, contributing to upward pressure on prices, and the floods. So higher prices for electricity and gas, and we know that July the 1st is going to be another uplift, which is going to really put the pressure on cost of living, and it's just another additional pressure that people around the nation will have. They've now got higher mortgage rates. They've now, of course, got higher payments at the gasoline and fuel pump, higher electricity bills, and of course the grocery prices are going up as well. So inflation is likely to be higher than was expected just a month ago. As the global supply side problems are resolved, many are anticipating that will happen organically at the back end of this year, and as commodity prices stabilise, even if at a high level, inflation is expected to moderate. Today's increase in interest rates, they're aiming will assist with the return of inflation to target over time. Of course, that's the objective with the rate rise. They want to curtail demand, they want to put the brakes onto the economy and slow down that runaway inflation, but they, of course, don't want to send the economy into a significant slowdown to risk the economic recovery or worst case recession, which, of course, is at the back of all of the central banks around the world's mind. The Oz economy is resilient, GDP at 0.8% for the quarter, 3.3% over the year. Key inputs here, household and business balance sheets are generally good. We know they were at record highs during 2020 and 2021. Of course, we've started to eat into those. However, as we'll see here, household spending evolves. Housing prices have declined in some markets, so potentially over the next period, if housing prices do continue to decline downwards, particularly as rates rise, there will be a bit of a wealth effect, which could flow through to spending as well. But this was what we were looking for here. The household saving rate remains higher than it was prior to the pandemic, and many households have built up large financial buffers. It's worth noting, of course, with the high inflation and wages starting to tick up, but not quite there yet. We've got negative real wages, and obviously with negative real wages, it means we're going to start eating into that household savings buffer. But for now, it remains higher than it was before the pandemic. The labour market is strong. We know unemployment's at 3.9%, lowest rate in almost 50 years, which is a significant one. Job vacancies, job ads, high levels. Further decline in unemployment and underemployment is expected. An interesting component is there's been a few different, potential canaries in the coal mine, particularly from some of the tech sector over in the US, with many of these tech names like Twitter, Meta, famously Elon Musk recently over the past period, 10% of their white-collar workforce, and some of the other companies have talked about the fact that they're starting to either put on hiring freezes or letting go of some of the staff. So, of course, this is a bit of an uncertainty to know what that actually means for the rest of the labour market around the world and across the different sectors as well. The bank's business liaison program continues to point to a lift in wages growth from the low rates of recent years as firms compete for staff in a tight labour market. The board will be paying close attention to the global outlook, which makes sense. Still clouded, still pressure on supply chains, still effects on energy and agricultural commodities. Real household incomes are under pressure in many economies. Financial conditions are tightening. And of course, what's happening is we're withdrawing monetary policy support to return to normalized conditions, because we had crisis time, ultra loose accommodative monetary policy. This is returning to more normalized conditions. Today's increase in interest rates by the board is a further step in the withdrawal of this support, as we discussed. The resilience of the economy, the economic recovery has been strong, not just in Australia, but around the world, and the RBA and other central banks have acknowledged that. The higher inflation means that this extraordinary support is no longer necessary. So given the current pressures, the board have decided to move by 50 basis points, higher than anticipated, but it is a step in the right direction. And as we can see here, just for a bit of a contextual backdrop, these are some of the other leading central banks around the world. If we look at some comparable ones, the US was at 1%. Oz hasn't updated, but we're now at 85 basis points, or 0.85. If we look at the Bank of England, they're at 1% already, but a few that have really got ahead of the curve or tried to be ahead of the curve is Canada, 1.5%. And another one that's quite a good comparable is New Zealand at 2%. So the RBA, yes, 50 basis points is a swift rise up. However, in comparison to some of these other comparable nations around the world, we can see that we're just getting back to those types of levels. In terms of what it could mean as well, I'm sure many of you have read a lot of the different discussions and analysis thus far, but just for a bit of a context, if fully passed on by the banks, which there's no reason that it wouldn't be, but if it is fully passed on, this 50 basis point rise, this will add $133 a month to a loan worth $500,000. With record high house prices, particularly in many of the key capital cities, $500,000 is, it's a standard type of mortgage, $133 a month, $265 a month. Of course, you double that if you have $1 million loan. But then, as we look a bit further out, if we get to the end of this year at 1.75%, which is what the market's pricing in, potentially 2.5% by the end of 2023, well, suddenly that $500,000 loan, you're paying an extra $100 a week, or $150 a week by the end of 2023. If this happens, of course, it depends how the situation evolves. If you've got that $1 million loan, that's it's over $200 per week just at the end of this year, and forecast to be $300+ a week for $1 million loan repayments to be able to pay that off. And so you start to see the real implications that this can have, not only in isolation, but of course, if you're an investor, potentially passing that on through the rentals, of course, the impact at the pump as oil prices continue to remain elevated, the effect on groceries and food and agriculture, and you start to see why cost of living is becoming such a key issue of discussion. And so the question is, what happens next? First and foremost, if this is your first time on this channel, we've just launched this second channel. So if you haven't yet, make sure you've subscribed and turn your bell notifications on so you won't miss any of the daily videos over here. It's great to have you join us. There are a few different factors to consider. The RBA, like other central banks around the world, are continue to wait for more data to be able to derive more insights and then actions from this. We know that it's an evolving situation, but there are a few factors that they are considering. First and foremost, as we did discuss, watching to see if those supply side inflationary factors start to ease, particularly towards the back end of the year. We know the market was pricing in rate hikes. It hasn't surprised anyone that there's been a rate hike and that it was a hot one. But it's worth noting that these are not going to be the first and now the second rate hike of the cycle. Of course, there's likely to be a few more, particularly as we get towards this neutral rate. And the RBA waits to see if curtailing demand is working and if we can start to bring that inflation down towards that 2 to 3% band that they are aiming for. It's also worth noting as well that real wages discussion, with inflation so high, of course, we're in negative real wages, but they'll continue to watch and await for that side. And they do want to see the impact of their rate rises and how that goes affecting the demand side. Of course, cost of living, the discussion is not going anywhere. There's still going to be a lot of different discussions. We've got the upcoming energy price rises on July the 1st as well. So it's likely that this is going to continue to be a narrative that will play out, and we'll be here covering it all. A big thank you for joining us. Let us know your thoughts with a comment below. For now, stay well and happy investing.